Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on December 17th, 2016. First and foremost, the markets this past week stagnated, but did display a couple of signs of volatility, of course, as we had the FOMC announcement. But more than looking backwards right now, let's be not only forward looking, but I want to explain a little bit on this weekend update here about risk reward scenarios and some what I view as great opportunities that exist in today's marketplace. So again, we'll come back to the S&Ps a little bit later. We'll come back to a kind of a forward look at markets, but let's start with some of the opportunities that I think exist in the market. So on TheoTrade on a day-to-day basis, I've been talking a tremendous amount about, again, what they call risk reward or risk reward scenarios that exist. And I'll give you a quick example, and we can use the SPX in this example. So the SPX is now traded, okay, from roughly 2084, and this is just looking again just prior to the election, 2084 up to, roughly speaking, again, we'll peg it where it is right now, 2258. So I'm not necessarily talking about anything like reversion to the mean here, but when you look at this scenario from where we are currently trading, which is right here, what do you believe at this point in time is the upside potential of the SPX versus the downside risks? And it's just something I want you to consider. Now, every one of you may have a slightly different answer for that. Okay, but we're going to look at a few equity products, okay, not necessarily an index product like the SPX, but we're going to look at a few equity products and make some arguments that even if you go into certain trades, let's say right now there's a 50% chance we go up, there's a 50% chance that we go down. But if we can set up an opportunity, all right, in this, again, let's just call it a 50-50, because every one of you, I mean, you're looking at the charts, you're trying to figure out direction, okay? Or as I term all the time, duration over direction. But let's just assume that everything right now is a 50-50 bet, okay? However, if you're wrong in this bet, let's say you'll only lose $2, okay? And if you're right, we might be able to make $4. Does that make this 50-50 scenario a viable trade? The answer is absolutely. The question is, how do we define this $2 versus the $4? And that's, again, where some of the opportunities exist in today's marketplace. So rather than me sit here and project, I can draw a bunch of lines on a chart. Now, we might go here, we might go here. Okay, we're going to start coming into some holiday trade. I know many people believe, the holidays are pretty much here, we're not going to have a lot of volatility. Well, last year we actually had a tremendous amount of volatility, not only coming into the Christmas week, but even between Christmas and New Year. So, I always argue, don't get off your guard. Volatility can come even when volumes are low. In fact, when volumes are low, you can even see more volatility. But let me present to you where I believe that there's some great setups for these risk reward style trades. And one of the underlyings that we've been trading a lot on an intraday basis as well happens to be Bank of America. So first and foremost, to present this, okay, let's look back at the recent move. So here's Bank of America, and I'll even start where Bank of America, roughly speaking, was trading right in and around the 17 level. Okay, now we'll take where it currently is right around 23. So for the most part, what we've already seen, okay, is a +6 event. That's a $6 move. Now, whatever you might think, okay, it's a huge percentage move. I mean, this thing is making a percentage move to the upside that it hasn't made, okay, since you got to look back in 2008, 2009, when the stock was getting decimated to see percentage moves like this. I mean, quite literally, you go back in like a 10-year to see moves this staggering, this quickly on a percentage basis. Again, you have to go back into, the 08 time frame and the precipitous drop that we saw. Now, again, not the argument. The argument in hand is, how big of a move is this? Again, statistically speaking, I guess a way to look at it, I'll look at an expected move right now. And what an expected move happens to be is, close up this left side over here. We'll look at the expected move right now. And in January, there happens to be 34 days left. Look, it's about $1.80. Okay, so what that means is Bank of America, even now with a rather elevated implied volatility, is looking at just less than about a $2 move in the next 34 days. That's what's expected. That's what the options pricing is dictating right now. And again, it has a relatively elevated implied volatility. So how big was our move? Well, it was $6. How long did it take to make this move from 17 up to roughly 23? Well, here we are on November 8th. Here we are roughly on, it's almost a perfect month. This is December 9th. Okay, so it takes exactly 1 month. So in 30 days, it moves $6. Okay, it's expected, again, if we look at what's called the EM, which is expected move, and I'll actually write it up over here. So the expected move, the EM, okay, is roughly about $1.80. The actual move, okay, is plus $6. Did the options market get it wrong? Yeah, the options market got it wrong, but by how much? Almost, okay, got it wrong by 3.5 times. This is actually what we're going to call, it's a 3.5 sigma move. It's 3.5 times, okay, standard deviation. And if you look at standard deviation and occurrences over there, you know, a 1 standard deviation move is 68% of the time. 2 standard deviations moves 95% of all occurrences. 3 deviation moves like 99.98. You're talking about like 3.5 deviation moves. Like, this isn't supposed to happen, but it does. It happened in a lot of different stocks after the election, right? Neither here nor there. Now, the question, that you may have is, well, how much further up could we go versus the downside potential? Okay, because let's say right now that there truly is a 50-50 shot in the marketplace. Okay, can the upside, could it move up another $6? Well, maybe. Okay, versus the downside. So at some point, I'm not, again, arguing reversion to the mean. It doesn't have to revert back to any mean. It could stagnate here for a while. But I believe at this point that the upside, okay, potential is limited versus the downside risks. And to further that point, I think we could set up a viable trade, either the 34-day expiration or even the 62-day expiration. And I can set up a trade that will give me a viable risk reward. Well, how do I do that? In this particular case, I'm going to use a synthetic short. What a synthetic short is going to do, number one, you could go out there and you could just outright short the stock. But if you outright short the stock and the stock explodes up to $30, you're like, oh, that's going to leave a mark, right? You get short a stock at $22.65, stock explodes to 30, you're like, ooh, you know, $7, $8 later, it hurts. It hurts, but there could be phenomenal downside opportunity here. So instead, I'm going to go right around about a 90 delta option. And what that 90 delta option is going to do for me, I'm going to buy, just outright buy. Not selling anything here because I'll tell you what, okay? There's a lot of risk to be selling premium in today's marketplace, but I'm just going to go buy this 25 put and I'm going to pay right around $250 for it. That's it. It's got about almost a 90 delta. And then in 90 delta, what that basically means, for those of you that haven't really played around too many options over here, this 90 equals the delta. 90 delta means it's moving at a rate of about 90 cents for every $1 move in the underlying. So you're getting about 90 cents bang for your buck. But if Bank of America starts moving down, the delta will rapidly become 1, which means you're getting what? Dollar for dollar movement on this option. The maximum risk, if you go out and buy, okay, the January 25 puts, the maximum risk is $2.50. If the stock rallies to 100, you're going to lose $2.50. The stock rallies to 30, you're going to lose $2.50. But if the stock sells off, okay, and sells off what? $2. $2, you're pretty much going to get out of the $2, about $1.85 of it. Okay. If the stock rallies, in this case, about $2, let's say the stock rallies, this, which is currently trading for $2.50, will still be trading for about $1. Okay. So if we sell off $2, you make about $1.85. If we rally $2, you're going to lose about $1.50. This is what I'm talking about with risk reward. All right. So you're looking at this setup, and in the setup right now, okay, and this stuff gets a little bit out there, but right now we're afforded the opportunity to trade this underlying. And if we're right, and let's say that, you get synthetically short and we sell off, okay, you sell off, and let's say we sell off in this case $3. Well, we went out and we bought this option. And what did we buy the option for? We bought the option for $2.50, and that equals the 25 put, right? So we paid $2.50 for it. If we rally up, okay, a full $2, well, I'll only lose about $1.50. Okay? But if we sell off 3, I'm making almost the entire $3. This is why this is a viable risk reward scenario. Not to mention that after we've already seen this +6 movement, okay, could there be more upside in the underlying? Of course, as I stated, I started this off. This could still be a 50-50 bet, but there's scenarios unto which the logic of the trade, okay, in this case, is far more important than the directional bias. And I'll clean this up over here. The logic of the trade is a very simple one. You select the right options, okay, the right duration over here, and you're putting on a trade that just simply has more opportunity than it does risk. And if you do those types of trades throughout time, this is how people become profitable, right? You put on smart trades that when you're wrong, okay, let's say in this case, if we're dead wrong, we lose the full $2.50. But when you're right, you can make $3, $4, okay? That's important. And these types of trades right now exist all over. By the way, if you don't like the January trade, you could put more capital at risk. You can go out here and buy the 26 puts for even $3.50. That'll give you 62 days. 62 days. And this can be done in an IRA, right? Because it's not actually shorting the stock. It's a synthetic position of just buying in the money puts. There's no dividend risk. There's no assignment risk because you're the buyer of the option. You have the rights. Okay. Yes, Bank of America is only one of many, many underlyings that have had explosive up moves after the election. Now, I really key into Bank of America because, frankly, I think it's one of the most important stocks in the marketplace right now. 150 million shares trade. Okay, that was on Friday. 550,000 option contracts. Okay, this is off the charts kind of numbers, and the stock actually closed down. So keep it in mind. Even if you don't do the trade, watch it over the next couple of weeks, even through the earnings. Okay, neither here nor there. Stocks that have had explosive moves, okay, you got to kind of love the risk reward scenario in here. Now, let's go back out of the risk reward scenario. And by the way, that risk reward scenario, that can be applicable to intraday trades. That can be applicable to trades for a few weeks, a few months, even years. I put on trades like this. So moving on over here, the markets right now, okay, are less about what you think and more about, okay, watching not only the S&Ps over here, because the S&Ps at this point, all right, well, maybe they've topped out for the time being. Again, we leveled out this week, but it's really, okay, much more about the bond product. And the bond product continues to sell off, although we are seeing some signs of what looks like, okay, that selling may have paused for the time being. The interest rates are becoming formidable at this point. We're talking about a 2.6% yield. That's the interest rate associated with the 10-year. And I say it's becoming formidable, okay, as you start to get up into the 2.7, 2.8%, okay, range, and that could really slam the brakes on the economy. Another big area that was relinquished this week was that China is no longer the largest sovereign debt holder of U.S. treasuries. It's now Japan. So China is just unloading treasuries. Now, of course, if you listen to the news over there, they'll tell you, well, it's to support their currency over there. How about it's to pay off huge amount of debt? Throughout the course of the coming weeks over here, eyes on Chinese markets. They've rocked U.S. markets in the past. They're selling bonds like they're going out of style. They're selling U.S. treasuries like they're going out of style, as are many other countries at this point. Where is the capital flowing, right? Probably in China to plug holes in their banking system over there. It's not being discussed a huge amount. Nevertheless, I think it's critically important. However, the bonds, for the time being, they look like they're ripe for a bounce. The bonds bouncing could be the top for the S&Ps. And at this point, that's of course what we're looking for. However, if you want to look for the top in the S&Ps, you need not look at the S&Ps. Okay? The only place you really need to look is, again, I go back over here to the financials. We're talking about Bank of America. Well, now we're back to the XLF. Okay? The single most important sector in markets right now is the XLF. Secondary to the XLF, look towards the Dow Jones transports. Okay, the transports, not because they're like popular. I mean, look at the transports. They're trading 8,000. They rally up to 9,500. People are getting euphoric. These are transports, people. This is a train. Did they reinvent a train? Have they? Okay, well, the economy is going to get much better. Yet from 8,000, every piece of good news from now on pretty much until the cows come home, okay, is priced into the transports for the next couple of years. Nothing else good can come out of the transports. Okay. Again, if you look at this product and you back it up for 10 years, okay, you don't see candles anywhere on the screen. Even when in 2008, when markets are crashing, on a percentage basis, you don't see moves this large. At some point, you might have to say, well, maybe we've gone a little too far. But again, what's important here, note the transports. If you're, a trend follower, I'm not much of a market technician, but you're a trend follower. I'm sorry, I think the trend has reversed course over here. So watch this coming week. Many people think we're in holiday trade. I'm not buying it. Okay. I think the volume has been intense last week. The volume was intense the week before. Okay. I think we're going to see some follow through to it. Sure, later this week. Okay. Coming into Friday and Christmas, maybe the volumes die down, but do not fall asleep at the wheel. You got to keep all eyes on, again, specific to the financials, specific to the transports. They're going to tell you what's going to go on in the broader market. Thanks, everybody, for joining us here at TheoTrade. My name is Don Kaufman. I will be in TheoTrade chat all throughout the course of this next week. Have a great weekend, everybody. Bye-bye.